Welcome, Drew, to April's update from Wattle Partners.
Pleasure to be here as always.
Another rate cut.
No rate hike. I'm still predicting rate cuts before the end of the year, but another rate hike sent us up to, was that 3.85%?
I think last time we were here, I said there was no
more rate cuts.
Increases.
Yes. We're a bit
but I
off
saw
today.
something recently that said potentially there's more rate increases in Australia, because if you look at the official rate in the US and in New Zealand, they're essentially nearly 1.5% higher than here.
I think we tend to extrapolate or compare other countries, even if they're significantly different to what's happening here, and we think we're the same as the US, but they've got some very different issues or trends within their economy. It's things like the impact of a rate hike in Australia hits residential, mortgage holders or just anyone that has a mortgage immediately, whereas in the US it doesn't hit those people. You only have to
in the US you have a fixed rate for 30 years.
Exactly. So exactly, and it actually hits businesses over there much quicker, and as we've seen, banks much quicker as well, because most corporate debt is either shorter term or renegotiated or floating rate. So corporates are being hit with higher costs. They're passing that cost on. Whereas in Australia, you're seeing consumption start to get hit. And we're filming this quite late. Apologies for that. Unemployment went up unexpectedly from 3.5 to 3.7% this week.
Yep.
It's kind of what the RBA wants.
For sure. In terms of bond rates too, great predictor of what's going to happen in the economy longer term. And if you start looking at longer bonds, they've actually been going down. Yeah,
I think the yield on the income you get from buying a 10-year government bond has reduced from about 4.2% at a peak to be something like 3.8% now.
Yep.
And the curve, so the yield curve, is if you think that the cash rate, so just having money in your bank account, is 3.85%.
Yep.
And the yield you get for a 10-year bond is 3.8%.
Yep.
It's either a negative yield curve or flat, which means you're not getting any reward for locking money up for a decade.
Yep.
And that tells you the market expects interest rates to either be flat or falling in the next 5 years.
And that means a pretty benign economy.
Exactly. If it was negative, you'd expect a recession, and naturally
increasing, you would expect a boom, essentially.
Yep.
Okay, great. And what about inflation?
Inflation seems a similar story, but not with a bit more nuance to what's happening in the US. It's been reasonably sticky, but it's also dropping pretty quickly. So it was something like 7.8%, fell to 7% in March, which is obviously reviewing April at the moment.
Sure.
But like we've seen everywhere, there's almost one-off or two-off events that are driving that inflation, and it's shifted from people buying heaps of clothes and goods to people spending time at restaurants. And I think airfares were up 30% over the 12 months to March, which has a big impact on inflation. Exactly. And I think you're seeing a pretty positive trend though, and maybe not in the UK where they've got massive energy issues, but in Australia generally, you're seeing the price of most things and inflation start to roll over from the peaks of last year.
Great, and we've had more news from the US reporting season, and three of our more favoured stocks in the tech market have done incredibly well.
Yep.
Microsoft, Amazon, and Nvidia. Their results prove that these businesses are scalable. They can grow in all conditions. Really good results. And
kind of unexpected sources of growth for some of them. Like I think it was actually laptops that did well for Apple, whereas traditionally it's been their iPhones or their wearables, because we have covered in Apple gear these days.
It's similar to Nvidia. Every time you try to get a straight line in their earnings, they reinvent themselves and they reinvent themselves and they reinvent themselves. So traditional valuation methodologies in companies can be thrown out the wall when you look at some of these technology companies, because you can't necessarily model their cash flows for the next 10 years because they invent their cash flows over that 10 years. So.
Exactly. And I think something that we're being reminded of is that earnings and consistency of earnings matters. Whether it's low interest rates or high interest rates, the companies that are consistently growing, whether that's profit or revenue, are always going to be rewarded.
Sure.
And this is the resilient companies that are dominating markets.
Especially companies can grow without capital or a lot of debt. So technology companies definitely fit that bill. And
you compare that to mining companies where it's, the price goes up 1 year and I think Woodside and BHP had 40% falls in profit and dividends this year. Solely because they're limited to what the price of one commodity does.
Sure, and one of those commodities is gold, and gold has reached a record high.
Yes.
So record high gold price would say there's some concerns around the economy going forward, and also people are concerned about inflation, and gold has essentially been known as an inflation hedge.
Yeah, definitely, and it's up in both. It's nearing an all-time high in US dollars. So I think it was about the all-time high is about 2,074.
Yep.
But then with the Australian dollar weakening, it's over $3,000 per ounce.
Yep.
So for a lot of clients, we've been holding this since $1,500 or $1,600 an ounce.
Sure.
And I think it's that powerful hedge within
Absolutely.
portfolios.
Like all hedges.
And not a trade.
All hedges, that has a role in portfolios.
Yeah.
Essentially, if the rest of your portfolio goes up, typically gold goes down. Vice versa, gold should go up when there's a bit of uncertainty around, and we're seeing that. So it's actually acting as a perfect hedge at the moment. We have seen a bit of turbulence in the US banking market, and we saw another bank fail or get really stressed, being First Republic, and that was bought by JP Morgan.
Yeah, definitely. And I don't think it's not unexpected. We spoke to an economist recently, it was Paul Bloxham.
Yep.
That his first comment was essentially this is exactly what central banks should expect.
Sure.
You're withdrawing liquidity from a banking sector that's had liquidity for a decade.
Sure.
And you're essentially reducing the value of their deposit or their liability or deposit base, which is putting stress on, and it's like a natural occurrence.
Yep.
And the risk is that banks become less willing to lend, which slows the growth of the economy, which sends the economy into recession. And there's growing likelihood of that from pretty much every economists we speak to and meet with.
Yeah, and then you're seeing a lot of new providers of capital try to come into the market, but it's very hard for those capital providers to even represent any portion of what banks historically have done.
Exactly.
So what Drew's basically saying is banks have been supported for the last 10 years. They're not being supported as much, and they have to cope with interest rates changing. It's just not households need to cope with interest rates changing, it's also the banks need to change with interest rates changing.
Yep.
And they've changed quicker and faster than we've ever seen in our careers.
And the cost of the capital they lend out, or they create credit, as I've got a client who reminds me all the time, banks don't take in deposits and lend them out, they create leverage by taking deposits and creating
It's only 10 to 1.
More money. Yeah, only 10 to 1.
Yeah.
But I have to reiterate that every time, otherwise
not risky, banks aren't.
Fred will send me an email. But it is that, the cost of getting that credit or getting that funding has increased, and the risk of defaults and arrears on the other side is increasing. So
Sure.
That's why we kind of predict or expecting interest rates to have peaked while the economy resettles itself.
Yeah, and maybe property markets in the last 6 months have kind of 6 weeks have reflected that, where property market values have actually gone up in the last 6 weeks, even though that we've been saying, hey, there's a lot of stress on property owners. People have seen some kind of reprieve and have pushed back into property markets with a view that, that we get a lot of talk from clients talking about immigration.
Yeah.
Immigration, I think this year is 400,000 people coming into Australia that will help with, jobs and wages, but they also need somewhere to live.
Yeah, and it's record levels again. And I think it came out a lot during the pandemic that, unemployment has gone down significantly because there are less overseas workers and there's more Australian workers in work, whereas historically
Less
there were more
people in the
Australian
pool.
workers. Yeah, exactly. And most overseas workers aren't included in the unemployment data at the same time.
Yep.
So as bad as it is, it can be a source of disinflation,
Yep.
where you're getting lower cost workers versus Australian workers. It obviously depends on your view on the economy and what's a fair rate of pay at the same time. But I think that's a super interesting and important trend because Australia's relied on immigration. I think in the budget papers, someone highlighted that we're in a per capita recession still, which means our growth of our economy per capita is actually shrinking, but the net value of our economy continues to grow.
Historically, over the last 20 years, we have had, a lot of immigration, and it did stop through COVID.
Yeah.
And you can see the effects on our economy. Basically, if you think about 3 years, we didn't have immigration, roughly 300,000 people a year at that point. There's 900,000 people that would be supporting the Australian economy that aren't. So really,
It's like every new person you get has an income, spends money, needs a house, needs all these things, and they all add to the size of the economy.
Sure. My
Most
son's
of them.
doing year 10 economics, and I talked to him last night about the multiplier effect.
Yeah.
So, essentially Do you want to explain the multiplier effect?
Not really. It seems like you're pretty fresh.
Yeah, no. Well, if essentially I have more money in my pay and I buy a loaf of bread from the shopkeeper then has more money. So he or she then spends more money, and it might be buying a drink next door. So it multiplies and multiplies and multiplies. So if you bring $1 into the economy, it actually has a multiplier effect. And depending on how you spend it, will determine on how many times you can multiply that $1.
Exactly, and the more powerful the multiplier, the faster the economy grows.
So in our portfolio, in the month of April, portfolio performance is pretty good, pretty positive month. If you think about the sectors that were down for the year, they were really up and up by the most. So areas like A-REITs and financials and the small ords did pretty well in that month.
Yeah, and generally yield and bond yield driven. So I think people initially thought interest rates wouldn't increase.
Yep.
And the sectors that are most sensitive to interest rates, so property and technology, were the key beneficiaries of that.
Yep.
And then in the portfolio itself, we talk about it all the time. How do you build resilient portfolios? And it's not always nice to put your top 5 and bottom 5 in every month. But it's just a reminder that a really diversified portfolio has things that go up some months and things that go down, because if everything's going up at the same time, it means you're not really diversified. So essentially, because we hold direct stocks in our model, they tend to dominate because they are more volatile. So massive results from Boral, so the cement producer, Woodside, which is benefiting, cash flow coming out from extended highs in oil and gas prices, and a boring list of companies, Cube, which owns ports, and Vicinity, which owns shopping centres. And then on the negative side, we had BHP cut after they cancelled the progressive dividend policy. For anyone who listens, I'll probably remember that quite fondly.
Sure.
But now their dividends are linked to their profit.
Yep.
And because their profit fell 40%, their dividend was cut 40%.
Makes sense.
And the share price, they're so sensitive to iron ore that was one of the big detractors. But still 6% in a month for a stock that's up 35% over the last 12 months.
I mean, measuring any performance over a 4-week period is really, really hard, right? So we're not really talking about what they did the month before or the year before that. So, top 5, bottom 5, great. There's nothing in there that surprises us. As you said, we know direct stocks have a lot of volatility. That's why you hold, at least 20 of them in a portfolio.
Yep.
But all in all, a pretty rounded month. We did add something to our recommended list, which is called the Rougher Absolute International Fund. So a little bit different. Founded back in 1994, £31 billion, I think, in their fund.
Yeah, in a single strategy. Yeah.
And they just do one thing. And essentially what they try to do is produce a return with the minimal amount of volatility. And they've been doing that,
and not lose money in any given year. And I think they've been running for, 27 years and in a calendar year. And they've lost money in 2 of those 27, 29.
1994. Yep.
So
a long time.
And that about us, for us, is about finding resilience. So there's probably growing range of outcomes from this point. You don't know if there's going to be a recession. You don't know how deep it'll be. Maybe we avoid it. But there's a growing range of those potential outcomes, and we're not confident in which one it's going to be. And we feel like this strategy's been suited to similar conditions of uncertainty, and it's incredibly active.
Sure.
And it hopefully removes emotion from that activity. So it offers like a hedge similar to the way that gold might work within a portfolio.
Great. And I skipped a bit here, but essentially this fits as a good prelude into it. Essentially, and taking what you've been saying, essentially diversified portfolios need to have diversified exposures. Something like the Rougher Fund adds diversity, but we've also talked about gold already. We've been adding long duration back to portfolios, and we have a diversified equity portfolio. So really important for people to constantly think about where they're exposed and how they're exposed. We are seeing a lot of clients come to us at the moment and they think they're diversified and they might have 10, 15, 20 funds, but all the funds are doing the same thing. Typically it's equity beta, e.g. market goes up, you go up, market goes down, you go down. And there's a better way to build portfolios, and you need to just open your mind to the concept of diversification and what it means and how you do it.
Yeah, exactly. I mean, we kind of covered the top 5 stocks before. Maybe Ramsay and Microsoft are worth pulling out. Ramsay's kind of having a return to normal. They own private hospitals across the world.
Sure.
PE, private equity tried to buy them, couldn't get it over the line. But profits are improving, and most importantly, not necessarily a great thing, but the backlog of admissions into public and private hospitals, they're seeing an inflow of admissions, which is central to them getting back to where they were before the pandemic. And then Microsoft, we use SharePoint across our business, so the SharePoint or the Azure cloud business was the standout in the last quarter. It grew 27% in a quarter. Like, we talk about 20% growth in a year. This is a quarterly growth of 27%, which is kind of...
If you think about cloud, it's been a phenomenon. And there's only a couple of players, Microsoft being one of them, Amazon being another, that really control this cloud market, and the growth they've been able to get. This is abnormal. But, quarter on quarter, year on year has been quite remarkable. And now Microsoft's push into the AI space kind of adds, this is what we're talking about before with some of these tech companies, the ability to reinvent themselves over and over without a lot of capital and with a large audience or distribution is quite amazing.
Yep, definitely. And we caught up with a couple of groups this week. I said Paul Bloxham, we saw present. Bombora, which was
Paul Bloxham is the HSBC economist.
Chief economist, yep.
So spent 9 years at the RBA. So find his commentary really good, really good to understand and meaningful to the portfolio. So maybe we'll be able to share some of his content.
Definitely. And then we caught up with, I think, BetaShares being the ETF provider, seeing where flows, where money's going to new ETFs. And then Bombora, which was a kind of interesting private market pre-IPO strategy.
Sure.
This is kind of a reflection of, we meet a lot of groups and try to act as that filter between new investment ideas and our clients, and constantly considering what's
some
happening in the
groups
market.
we don't even meet, but
that's part of the filter.
And so two groups that we're big fans of. So obviously, from our history and where we sit now, we fundamentally believe in financial education or financial literacy and improving financial literacy. So Drew and I had the pleasure of sitting on a panel session at the Australian Shareholders Association talking about transfer of wealth and the emotions around transfer of wealth. So was there any big takeaways from that, Drew?
I think that the knowledge base isn't always as good as we think it is for retirees and just Australians in general of financial literacy. And it is so personal, and there's so much flexibility around the transferring as wealth that everyone was looking for a simple answer from us, I think, sure. And it isn't that simple. I think the one thing when I talk about transfer of wealth and educating the younger generations, I'm kind of talking about making sure if you're buying them something to invest to hold, and make sure it's relevant to them. So if they're interested in cybersecurity, or if they like technology, or make sure you're buying an asset that is related and something they're relatable for them, rather than historically you and I probably were given BHP and Telstra shares. Sure. Very difficult to relate to these days. Yeah, exactly. So that was a big part of that. You talked very much about transferring wealth is not just in dollars.
I think I said, love, education, and then money.
And education's so much more valuable.
Yeah. And then we talked about timing as well. A lot of people, and the love bit is that essentially you need to have contact with your family, and that's the most important part. But a lot of people that we see don't have relationships with their children or their grandchildren, and they leave it to the last minute to donate the money to them. So how do you do that in this kind of, make sure they're educated like you're saying, make sure it's timely, so it's not, a lot of our clients live into their late 90s, their children are in late 60s, so transfer of wealth in your late 60s might not be the best time. There was a better time to transfer wealth, people getting better education, buying houses, retiring, etc. So I think that was really interesting.
I'm going to put this one on you. The basic investment concept for the month. We put a choice of 3. I'm going to say, why would you hold a bond? I'll give you the easy one. This is a government bond as an investment, not an investment bond, which is another option.
So, I mean, it really comes back to what we were saying before. Diversity is the key to active, long-term portfolio construction, but you need components. And the two components that you have the two main components you have in a portfolio, the two starting building blocks you have in a portfolio are basically equities and bonds. And why do you have equities and bonds? Because they act totally different to each other. Typically when bonds go up, equities go down. Or when maybe I reverse that. When equities go down, bonds go up. So what is a bond? Why hold a bond is just that diversity and the income.
Yep.
So at the moment, you're probably long bonds, you're getting 5%, 5.5% on a decent diversified portfolio. But if the market is going to go, if the economy is going to go in recession and the market follows, the value of bonds will go up because interest rates will go down.
Yep.
And that's the case for the last 50 years, apart from the last 5 years, where bond rates were zero and there was probably no real reason to hold long bonds. But we're back to a more traditional landscape. It's actually easier for you and I to build portfolios than it has been in the last 5 years.
Yep.
And bonds play a really, really important role in diversification.
Yep. And I take that out. So the two topics of interest, I just picked a few out, is on the podcast we get a lot of questions that people talking about either borrowing to invest in shares, but there's this assumption that shares go up 10% every year. And I think it's worth reminding that it's a very, very long-term average. And I think in the last 3 years alone, you've seen a negative 17% return, a negative 10%, and a 7 or a 20%.
Sure.
And the average was 10.
Yep.
But if you invested at the beginning of any of those periods, your outcome could have been completely different. So it's this concept that don't oversimplify, and nothing really works in a straight line.
Yep.
It was kind of a reminder that we kind of talk about regularly. And then probably comes back to our golden rules as well, which is cutting losses. And I think one of the big parts of our golden rules is things will go wrong. And as we talk about, you're not diversified if some parts of your portfolio aren't performing as well as others at the same time. The key is
cutting losses, or really having a framework to make decisions. And a lot of time on investments and stocks, we've lost 60 or 70% and we want to hold it. It's really a framework then.
Yep.
So to be meaningful in the portfolio, you have to increase it back up to the average.
Yep.
Most people won't do that. So if you're not going to do that, then just sell it, right?
Yep, exactly.
And move on, reinvest the capital somewhere else. There's also unlisted assets we might touch on quickly, VC, pre-IPO, PE. I think the question about interest rates and valuations is a good one, and we're going to see a lot of different valuations come in at 30 June, and they'll be interesting. If you're allocating money to these asset classes, I think they're still really attractive, but you might want to really think about the instrument that you're investing into. So if I was buying real estate now at a 15 or 20% discount than it was 12 months ago, fantastic, right? Yeah. Yield's great. But if I was going into a diversified fund that's buying real estate right today and it hasn't had a revaluation of assets, I think that's a really quick way to lose money.
Yeah.
So,
and we see that in kind of the industry fund world, or I just look out the window sometimes and you say if there were two identical buildings next to each other, one would currently be worth 20% less than the other one solely because the owner of it doesn't have to, adjust the valuation every day, whereas one owner's on the ASX.
I'm not saying this, but Drew is. If there's two properties the same and one was owned by a super fund, it might be worth more than one that's not.
Based on today's prices. That's essentially unlisted versus listed assets. The listed market is telling it's worth less.
The industry fund gang is about to knock on our door, so maybe that's a great place to end this monthly update. Thanks everyone for listening. Thanks, Drew.
Good to see you.